You know that specific kind of anxiety you get? When you look at the stock market and it's like hitting all-time highs, but then you look out the window at the actual economy and it feels like everything is held together with duct tape.
Oh, yeah. The dissonance. It's loud right now.
It's deafening. It is. It's like we're all agreeing to play a game where the points don't matter, but the points are also, our retirement funds.
Right.
And that is exactly why I wanted to pull this specific source today. We are looking at The Architecture of Anti-Fragile Wealth by Dr. Pooyan Ghamari.
And Ghamari, I mean, he isn't exactly subtle about it. He's not saying we're in for a correction. He's saying the map we've all been using since, 1980, it's actively leading us off a cliff.
Right. He's a Swiss economist, a strategic advisor, and apparently a guy who really hates the status quo.
Right.
The core idea here is anti-fragility. And before we get into the buzzwords, I just want to set the stage. This isn't just how to survive a crash.
No.
It's way more aggressive. It's about building a portfolio that eats chaos for breakfast.
Which is a lovely image, but it requires a total mental reset. Most of us are trained to look for stability. We want that smooth line on the graph going up and to the right.
Of course.
But Ghamari is arguing that seeking stability in a system that is fundamentally chaotic is actually the most dangerous thing you can do.
Because when the dam finally breaks, the stable people drown first.
A bit grim, but yeah, pretty much. He starts by dismantling what he calls the old maps. And the biggest casualty here is the sacred cow of personal finance, the 60-40 portfolio.
Oh, man. I feel like we need a moment of silence for the 60-40. 60% stocks, 40% bonds. It was the set it and forget it strategy.
The vanilla ice cream of wealth.
Totally. And it worked. That's the thing. It worked beautifully for 40 years. But we have to understand why it worked. It wasn't magic.
It was the great moderation. That's what economists called it. We had falling interest rates, relatively stable geopolitics, and crucially, low inflation.
And the correlation was negative. That's the technical part people sometimes miss. When stocks crashed, investors would flee to the safety of bonds, so bonds went up. They balanced each other out.
That is the key mechanism. But look at the last few years. Inflation spiked. Central banks hiked rates. And what happened?
Both went down.
Stocks went down because money got expensive, and bonds went down because their yields went up. The correlation just flipped.
And suddenly your safety net is falling at the same speed as your risky assets.
Which Ghamari calls a house built on moving ground. He argues the 60-40 relied on a world of, let's say, predictable institutions. It assumed the Federal Reserve or the ECB could always step in and, smooth things over.
But now those institutions are the ones causing the volatility.
Exactly. And this is where his critique gets really biting. He starts talking about prices not being real anymore.
Policy experiments is the phrase he uses.
Yeah. When you look at the price of the S&P 500, are you actually seeing the aggregate value of corporate earnings? Or are you just seeing the result of trillions of dollars of liquidity injections and algorithmic feedback loops?
The feedback loops, that's the part that scares me. I mean, we aren't just trading against other humans anymore.
Not even close. High-frequency trading algorithms, they execute transactions in microseconds. They react to keywords and headlines, tiny price discrepancies faster than you can blink.
Wow.
Ghamari makes a point that I think is crucial for individual investors to hear. If you are trying to trade this market based on fundamentals, you are bringing a knife to a nuclear fight.
Human analysis is just background noise to the machines. So, okay, if we accept that the old map is burning stocks and bonds are correlated, prices are manipulated by policy and bots, what's the alternative? Because put it under the mattress is also a losing strategy with inflation.
Right. And this is where we pivot to anti-fragility. It's a term he borrows from Nassim Taleb, but Ghamari applies it very specifically to wealth architecture.
Okay, so distinguish that from resilience for me. Because I think people use those words interchangeably.
They do. So resilience is a rock. You punch it, it doesn't break, but it just stays a rock. It doesn't get better.
Okay.
Anti-fragility is more like the human immune system. You expose it to a pathogen and it learns, it gets stronger. It actually benefits from the stressor.
So in financial terms, a resilient portfolio survives a crash. An anti-fragile portfolio makes money from the crash.
Correct. And to do that, you have to move away from systems that rely on trust in human competence. And Ghamari's big example here is decentralized finance, or DeFi.
Okay, let's pause here. Because usually when people hear DeFi, they think speculative crypto gambling.
Right, meme coins and all that.
But Ghamari is looking at the structure, not the speculation.
He's looking at the plumbing. Think about a traditional bank. It relies on a ledger kept by humans, regulated by humans, and it's totally subject to the political whims of whatever jurisdiction it's in.
So if the bank fails, or the government freezes accounts, or the currency devalues.
You're fragile. You're completely exposed to counterparty risk. You're trusting the guy on the other side of the table not to just flip the whole table over.
Right.
DeFi, at its core, and we're talking about the true decentralized protocols like, say, Uniswap or Aave, it removes the guy at the table. It replaces him with code, with smart contracts.
With automated market makers.
Exactly. The rules are mathematical and they're visible to everyone. If volatility spikes, the protocol doesn't panic. It doesn't call the government for a bailout. It just executes the code.
It liquidates positions, it adjusts fees.
And that volatility actually generates more fees for the people providing liquidity.
So the chaos of the market becomes the fuel for the yield. That's the anti-fragile mechanism.
That's it. When trust in central authorities erodes, systems that don't need trust become premium assets. Ghamari argues that as political theater gets louder, the quiet certainty of mathematics becomes the most valuable thing in the room.
But, you can't live entirely on the blockchain. You can't eat Bitcoin. And this brings us to the second pillar of his thesis, which I actually found even more compelling than the digital stuff, the skeleton of the economy.
This is his big reality check. He's very dismissive of what he calls the app layer of technology. He basically says, stop looking at the clever chatbot and start looking at what the chatbot is eating.
Energy and chips.
It's the infrastructure of the future. He calls it durable value. See, we have this obsession with software because it scales infinitely with zero marginal cost. But AI, the thing that's driving the current bubble, is incredibly physical. It's hungry.
It's just electricity and silicon when you boil it all down.
Enormous amounts of electricity. And very specialized semiconductors and copper cables to connect it all. Ghamari's point is that we are entering an era of physical scarcity. You can print fiat currency, but you cannot print a gigawatt of power or a cobalt mine.
So the anti-fragile play here isn't buying the stock of the hot AI company that might go bust in 5 years.
No.
It's owning the copper mine that supplies the grid that the AI company needs just to exist.
Exactly. You want to own the bottleneck. If the world becomes more digitized, the demand for physical infrastructure goes up. If the world deglobalizes and supply chains break,
The value of domestic resources and energy production goes up.
it wins either way.
That's the definition of anti-fragile. But, and here's the catch, allocating capital to these kinds of things isn't as easy as just buying an S&P 500 ETF.
No, it's not. And this was the part of the source material that made me feel a little tired. The section called From Buyer to Builder.
Me too. Ghamari's basically saying the era of passive investing is over.
He is. And that's a really hard pill to swallow for a generation raised on, the little book of common sense investing.
We were told you can't beat the market, so just buy the whole market and go play golf.
And Ghamari argues that strategy leaves you blind. If you just buy the index, you're buying the overvalued tech, the zombie companies, the failing banks.
You're buying everything.
You're buying everything. In a structural shift like this, you just can't afford that drag. He says capital allocation has to become a creative act.
A creative act? That sounds like he wants me to quit my job and become a full-time macro strategist.
Well, maybe not quite that.
Yeah.
He's arguing for competence. You don't need to be a chip designer, but you need to understand the semiconductor supply chain enough to know where the real value is.
Okay.
You need to understand energy grids enough to know why renewables might struggle to power a massive data center.
So it's about specialized knowledge. We can't just delegate our understanding to the talking heads on CNBC anymore.
Or to your financial advisor who's just putting you in a 60-40 model because that's what his compliance department tells him to do. I mean, Ghamari lists some heavy topics we need to grasp: encryption, energy systems, data governance.
It's like a syllabus for the 21st century.
It is. But the insight is that the real value is found at the intersection of these things. It's where automation meets ethics, or where energy policy meets chip design. If you can understand those intersections, you can build a portfolio that, again, doesn't rely on prediction.
Because prediction is a fool's errand in a chaotic system.
Right. You don't try to predict when the earthquake will happen. You just build a building that can sway.
Okay, so we have the digital safety net with DeFi and math. We have the physical safety with resources and infrastructure. But then there's the question of where you actually keep this stuff. The whole jurisdiction section.
This is the most political part of the text, for sure, but he tries to treat it purely as a risk management issue.
He challenges the whole idea of birthplace as destiny.
Which is how it worked for most of history, right?
Yeah.
You were born in France, you kept your money in France, you followed French laws. But now wealth is digital, it's mobile, it's controlled by private keys, not by government permits.
But the human is still physical. I can't upload myself to the cloud just yet.
And that's the tension. You are physical, but your assets might be digital or global. Ghamari argues you need to treat jurisdiction as another tool. You need what he calls jurisdictional arbitrage.
Which, usually sounds like code for tax evasion.
And he explicitly warns against that interpretation. He says this isn't about hiding, it's about resilience. It's about not having a single point of failure. If you live in the UK, bank in the UK, and hold all your assets in British pounds.
You are 100% long on the UK.
Yes. And if the UK makes a really mad policy decision, you go down with the ship.
So he brings up the Swiss model.
He does, and obviously he's biased, being Swiss. But the logic holds. Why has Switzerland succeeded for so long?
Neutrality. But not just we don't fight in wars.
It's legal neutrality. It's the historical refusal to weaponize its financial system. And Ghamari translates this to the digital age. He says we should look for jurisdictions that offer cryptographic certainty and equal rules for all participants.
So in a world where major powers are freezing assets and using currency as a weapon, you want a jurisdiction that just cares about the contract.
You want a jurisdiction that respects ownership above all else, whether that's a physical place like Switzerland or Singapore, or a digital jurisdiction like a decentralized blockchain. The goal is just to separate your wealth from the political mood of your home country.
It's the ultimate diversification then. Diversify your assets, diversify your knowledge, and diversify your geography.
It's about ensuring that no single bureaucrat, no single central bank error, and no single algorithm can wipe you out.
So let's try to pull this all together, the great synthesis, as he calls it. We have these three pillars: knowledge, allocation, and jurisdiction.
And they feed each other. You need the knowledge understanding energy, codes, supply chains to know where to allocate capital. You allocate that capital into anti-fragile assets like DeFi or commodities or infrastructure.
And then you wrap that whole allocation in a jurisdiction that protects it from confiscation or, regulatory overreach.
It's a fortress. But it's a fortress you have to build yourself.
And that's the intimidating part.
It is. And Ghamari acknowledges this. He has this phrase I wrote down: education precedes movement.
Which is good advice because my impulse is usually to panic buy something I don't really understand.
Right. And he says, small positions grow as comprehension matures. Don't go dump your 401k into a copper mine tomorrow. Start small, learn the mechanics. If you don't understand how a crypto wallet works, learn that first with $50 before you even think about putting in $50,000.
It's that balance he talks about between urgency and patience. Patience must walk beside urgency.
I think that's the philosophical core of the whole text. Urgency because the old map is on fire, you can't stay where you are. But patience because if you run blindly into this new world, you'll just fall off a different cliff.
Delay is vulnerable, but haste is fatal.
You have to move, but you have to move with precision.
It really reframes the role of the investor, doesn't it? You aren't a consumer of financial products anymore. You're the architect of your own survival.
And that's empowering in a terrifying sort of way. It means the outcomes are entirely on you. There's no manager to blame.
I think that's the provocative thought we need to leave everyone with. We started this by talking about that feeling of the ground moving beneath your feet.
The vertigo.
Right. So looking at your own situation, your savings, your investments, where you live, you have to ask yourself, is your safety dependent on the world staying exactly the way it was in 1995?
Are you just betting on a return to a normalcy that isn't coming back?
Because if you are, you're just a passenger in a car that's driving itself, and the GPS is broken.
And the driver might be asleep at the wheel.
Better to grab the wheel yourself.
Yeah.
Dr. Pooyan Ghamari is The Architecture of Anti-Fragile Wealth. It's a heavy read for sure, but man, does it wake you up.
Absolutely. Time to start drawing a new map.
Thanks for diving deep with us. We'll see you next time.